I know you're saying to brace for volatility, and we've certainly seen it this week. The market's up on Monday, down yesterday, futures up again today. How much do you see that as being tied to bond yields?
I think that's certainly one of the prime factors. That's not going away anytime soon, Frank, as we continue to see additional stimulus, as your previous guest mentioned, signs of economic recovery. We think these bond yields are going to come up. You also mentioned the whole Robinhood Reddit trade now moving away from stocks into crypto. And so much focus right now is on vaccine distribution and stimulus. But we believe by the summer, you're going to see tax reform really come to surface. And now when individuals and corporations think about higher tax rates, I think this is all a recipe for this level of volatility throughout the year.
Yeah, we'll certainly have to continue to watch the VIX, Greg. A lot of talk about bonds and how they might impact equities. A lot of people concerned about that, but there are still a lot of people that have fixed income investments as a big part of their portfolio. For people that really want to double down or invest more in fixed income, what would you suggest? What's the strategy you should use as we're seeing these bond yields rise?
It's a really important question, Frank, because the last decade and the last year especially, it's been a rising tide for all fixed income investments, bond ETFs, bond funds, corporate, taxable, tax-free. I think in this period of rising rates, people are seeing, at least as of Friday, the aggregate bond index was negative year to date. So we believe that you should take sort of core and a satellite approach to your bonds. The majority of the bonds are the safe, fixed portion of your portfolio. You want to ladder your bonds. You want to stagger maturities where your interest principal payments are guaranteed, especially for those in higher tax brackets, Frank. The spread of tax-free to taxable debt has been pretty positive over the last year. We believe that trend continues too. Just understand what you own. And we're not suggesting that high yield is appropriate. Hey, look what the Fed's doing. The Fed's investing in mortgage-backed securities and corporate debt. And we think that's appropriate. But make sure that core component of your bond portfolio is in a fixed, laddered portfolio.
Yeah, great advice there. But Greg, you're not just a bond guy. You also talk about different funds. Let's talk about two that you're looking at, a life care and health sciences fund, the ETIHX, and also an emerging markets fund, the SPEM. Tell us, with the reopening happening, and we're seeing that rotation into materials and industrials, other investors doubling down on that reopening, why are you looking at healthcare and outside the U.S. when the world's biggest economy looks poised to reopen?
For sure. And we're not suggesting that those cyclical names won't do well in the next 6 to 9 months. However, I think it's important to understand what worked really well last year may not work as well going forward. And so when you think about disruptive technologies, think about the largest growing segment of our population, over 65 and above. That population is going to need more healthcare innovation by growing biotechnology companies that are developing gene therapy, cell therapies, genomics. These are trends we see. Look at what we've learned in this vaccine delivery in less than 12 months. Those same efficiencies are being applied now to all these diseases. So there's a burgeoning amount of growth that's happening in these emerging healthcare sectors that we think warrants investors' consideration.
Shepard Smith here. Thanks for watching CNBC on YouTube.